our call really hasn't changed. We're very disciplined on price, and as you know, we got tactically bullish last fall at 3,500 because that was a good price, and now we're of course back to the high end of the range, and that's not a good price. And that's at the S&P level. That's not really what's been interesting over the last 6 or 7 months. As you know, what's been interesting is what's going on under the surface. I would say in the fourth quarter, that was a very hated rally because it was led by kind of the old economy, financials, industrials, energy, materials. It was all based on, the China reopening story, which was legitimate. And technology stocks obviously disappointed, and they did not trade well in the fourth quarter. So it was a hated rally because that's what people own. Now, of course, the S&P is trading at the same price it was in early December when we got cautious again, and tech is obviously going to the moon. And now this rally is loved because this is what people want to buy. This is what people want to own. It's a lot more interesting and, kind of exciting to own AI and technological revolution than it is to own some those old economy stock. It's, well, why do I want to own this long term? So it's just an interesting development. We would characterize this as the bear market is continuing. Okay, this is what bear markets do. They're designed to fool you, confuse you, make you do things you don't want to do, chase things at the wrong time, probably sell them at the wrong time. And we think the overriding driver, okay, of this year's rally has been increased liquidity. Liquidity has improved dramatically, both on a global scale, and the weaker dollar has helped. That's going the wrong way now again. And then, of course, ironically, the banking failures that happened in March led to an injection of liquidity from the FDIC and the Fed. And we think those things have really conspired to drive the market. I mean, nobody talks about the fact that crypto is up 60% this year, okay? And then the next one, of course, is the tech world. So this is what's going on. We think that the fundamental case does not support, where stocks are trading today, whether it's at the index level or at the single stock level. And the second half is going to be a bit choppier and probably downward in the index.
Why do you think it can continue, Tom?
Well, we know bull markets climb a wall of worry, and we know that there's a lot of things that we visibly worry about, including debt ceiling, inflation, the Fed, regional banks. But I think the message that's come out in the last couple of months is companies have been incredibly resilient. They manage costs really carefully. They've been selective in how they manage prices. They've been really good at targeting customers, and I think that's what's paying off. They had a great first quarter earnings season, and as you know, at several of these conferences, they haven't been cutting guidance. In fact, I think they've destocked, so I think there's still upside to earnings. That's one positive story. And the second, of course, is positioning, because people really did rage sell last year, but we know that the bond market is sort of signaling a softer landing than many were expecting. I think that's positive for equities.
So you think there's still going to be a chase to come, at least as it relates to tech, because you've gotten a year's worth of gains in these stocks, and in some cases you've gotten like 5 years worth of gains. It's been quite remarkable, and you know exactly what I'm alluding to. The fact that NVIDIA and stocks like that up 100% year to date plus, and don't seem to want to let up.
Yeah, I think what's interesting about NVIDIA is that this was not a widely shorted stock into the results. So that 30% rally was really the market recognizing they have to reprice the future cash flows. I think that's pretty true for most of the FANG trade. One of the reasons we thought it would be our top sector pick this year was that all this wage inflation and need to boost productivity was going to be solved by these FANG companies. And that ultimately translates into better than expected growth. I think that's really the thesis. And it sort of explains why FANG has really led this year, but I don't find them actually expensive stocks.
Well, not necessarily, not at all. In fact, it kind of sets us up where it's probably inevitable now, because what's happening is you're basically forcing people into these stocks at bad prices now. The valuations last fall on these stocks in particular was extremely attractive. And if you look at the performance of all of these names, with the exception perhaps of the one this week, which, earnings are going up, the earnings are not driving these stocks. It was 100% multiple expansion, which goes back to our liquidity question. So look, the price is wrong in our view, because the earnings are probably going to be wrong for most of these stocks, not all of them, but most of them. And so from here, we think it is still a stock picking game. And of those 6, 7, 8 stocks, my guess is 2 of them will probably be okay, and the other ones will not, because they are the economy. Okay, they can't avoid the economic slowdown and the top line slowdown that we see in the second half of this year.
Wow. The divergence, though, between FANG and some of the others and the rest of the market doesn't concern you? I've cited some of the numbers that are out, and you've seen them yourself, I'm sure. Bespoke, the 3-month performance spread between the S&P and the equal weight S&P, the widest it's been since December of '99. We all know what happened in 2000, and the point that is, you know, the intent of this data, Tom, it doesn't make you a little nervous?
It does, Scott, because, you know, market breadth is important to confirm a trend, but I also think it's explainable. I think there are some binary events that naturally would make people cautious, like this debt ceiling. It's hard to say, how do you find equilibrium price today? One thing that we pointed out to our clients this morning was that when you look at industrials and consumer discretionary, there's actually quite a lot of good market breadth, well above the S&P overall, and tech ex-FANG, and even healthcare. So I think groups actually have more performance underneath than is visible. I think a lot of people started too glib saying it's just FANG and nothing else. There's roughly 200 stocks outside of FANG that are outperforming this year. That's actually not bad.
I think you could debate this one way or the other, meaning when you make a market low, you typically do have, you know, severely negative breadth. That is a good sign. However, the index is usually down with it. So we think where we are is the index is telling you things are rosy, things are fine, and the breadth is telling you otherwise. And then when we put our fundamental overlay on top of that, which is, you know, we're way out of consensus now on the earnings front, then we can make the conclusion that the internals, right, the breadth is being one of those, but the internals and the leadership is telling you that growth is going to be a problem in the second half of this year. Whether that's an economic recession or not, we think it's going to be an earnings recession that's way worse than what people are currently modeling. And look, I want to go back to the beginning of the year. You know, you guys are good readers of our reports. You remember in the beginning of the year, I was somewhat nervous that everyone was in the same camp at that point. Our view is very consensus on the fire and ice, you know, the tightening and then the slowdown. And so we were trying to figure out, well, how could everybody be right? That doesn't work. And so what we've done now is we've worked off that oversold condition. And more importantly, now I would say the consensus is actually optimistic on earnings again. And that's just where we completely disagree.